On August 5, 2024, Japan's Nikkie 225 stock index experienced a historic drop, marking its most severe single-day decline since the notorious Black Monday crash of October 1987. The index plummeted by an extraordinary 12.4%, losing 4,451.28 points and closing at 31,458.42. This dramatic fall erased billions in market value and reverberated through global financial markets. Factors contributing to the decline: U.S. economic concerns. The unprecedented sell-off was driven by several key factors. Primarily, concerns about the U.S. economy were a significant catalyst. Recent economic indicators suggested a possible recession in the U.S., which unsettled investors worldwide. The Federal Reserve's recent decision to raise interest rates exacerbated these fears. Higher rates generally lead to increased borrowing costs, which can stifle consumer spending and business investment, further intensifying worries about an economic slowdown. Impact on Japanese exporters. For Japan, the impact was especially pronounced due to its heavy dependence on exports. A potential slowdown in the U.S. economy posed a serious threat to Japanese companies that rely on American consumers. Additionally, the yen's recent appreciation against the dollar further compounded difficulties for Japanese exporters, making their goods more expensive and less competitive in the global market. Sector-specific impacts. Technology sector. The market decline affected nearly every sector, but technology stocks were particularly hard hit. Companies like Sony, Toyota, and SoftBank saw substantial drops in their share prices, contributing significantly to the overall downturn. The technology sector's vulnerability was heightened by worries over supply chain disruptions and diminished consumer demand. Financial sector. The financial sector also faced considerable pressure. Banks and financial institutions, which are sensitive to changes in interest rates and economic conditions, experienced sharp declines in their stock values. Concerns about potential increases in loan defaults and decreased profitability in a sluggish economy contributed to the sector's struggles. Government and financial authorities' response. Bank of Japan's measures. In response to the crisis, the Japanese government and financial authorities took swift action. The Bank of Japan introduced measures aimed at stabilizing the financial markets, such as increasing asset purchases and injecting liquidity into the system. These steps were designed to support the financial sector and restore confidence among investors. However, the immediate effect of these measures was somewhat muted, as investor sentiment remained unsettled. Fiscal policies. Alongside monetary interventions, the Japanese government explored fiscal policies to stimulate economic activity. Potential measures included boosting public spending on infrastructure projects and offering tax incentives to encourage business investment. These policies were intended to counteract the effects of the market downturn and spur economic growth. Broader implications. Global market reactions. The substantial drop in Japan's stock market had significant repercussions across global financial markets. Major stock indices in the U.S., Europe, and Asia also saw sharp declines as investors responded to the news. The interconnectedness of global financial systems meant that the fallout from Japan's market crash reverberated worldwide. Investor behavior. The dramatic sell-off highlighted the critical role of investor behavior and sentiment in financial markets. Panic selling and herd mentality can exacerbate market downturns, creating a feedback loop of declining prices. The events of August 5, 2024, underscored the importance of maintaining a calm, long-term perspective rather than reacting to short-term market fluctuations. This historic decline serves as a powerful reminder of the global financial market's interdependence and the far-reaching effects that economic and geopolitical events can have. It also emphasizes the need for vigilance and proactive strategies to manage risks and maintain financial stability. As the situation unfolds, both investors and policymakers will need to closely monitor developments and adjust their approaches to navigate the evolving challenges. Join our vibrant community and be in the know by subscribing to our channel for the latest news and captivating content.